Oops, too far. Okay, so my name is Colin Shepherd. I'm with Hines. And Hines has been mostly known, Ed introduced me as a developer, and that has been what we've been most known for over the last 60 years. About 4 years ago, I moved from our development side into investment management. And we had over 60 years, about 25 years ago, we began doing fiduciary investment management, not just partnering with our partners, but investing on their behalf. But I was involved in development for my first 3 decades at Hines, up and down the west coast of the United States. This, to the right of this screen, on the screen, is the Salesforce Tower that we're building today with Boston Properties as our partner. Going to be a tremendous building in downtown downtown San Francisco, excuse me. I'm going to talk about investment perspective as it relates to the globalization. At Hines, we, like the rest of you, I think, fully and totally believe that the globalization that's being discussed will absolutely occur. It is going to be the future. It's happening all over the world. We're active in 20 countries, 199 cities. We're investing and developing in those places. And we can see it in even a country like Poland, where the total population is diminishing. The major urban centers are continuing to grow at a considerable pace. To get a sense as to who I'm really talking to right now, can I get, how many people in the audience would describe themselves as an investor? It's a pretty good number. And how many are investment managers, or is that the same thing? And then how many are consultants to investors? Wow. Well, it's great seeing you all. I'll tell you. But I'm going to talk about from the investment perspective. We do invest and develop across all of the major product types. So within real estate, that's everything from multifamily to office to industrial to retail to loan products, actually. So we're investing. We have about $87 billion under management today. When you think in terms of globalization and look at it from an investment perspective, the first issue is to understand that that's not a short-term tactical strategy. That's a very long-term strategic investment. You really need to be thinking it in the context of those issues. And Andy talked a lot about live, work, and play, and the number one driver of what cities will be the winners. It's not just because Donald Trump says they're going to be huge. It's because it's where people want to live, work, and play. And so what is determining where people want to live, work, and play? Everything from economic opportunity to environmental to educational opportunity, healthcare, quality of life, et cetera. Within those markets, it's equally from an investment perspective important to understand not just which overall urban centers will be the winners, but which submarkets within those centers will be the winners. At Hines, we have our own research group internally that we started about 45 years ago, 4 or 5, not 45, about 4 or 5 years ago, and we look and we track across the United States alone. That's about 530 markets, meaning we count each individual product type and geography as a separate market. So, Los Angeles, that would be 4 markets when we look at the 4 different types. We then have submarkets that we look at to try to determine the winners. And over time, we have tracked proximities to certain things do change both how much rent people will pay, so they're voting with their rent dollars, and what the value of those assets are. And it can be quite profound. In a strategic investment long term, we have very simple principles here. I'm going to hit them very high level and move on. But very simple principles. Number 1, capital preservation. Number 2, cash flow, reliable cash flow. And number 3, asset outperformance. We look at the preservation of capital in the context of a real term basis. So it's, will your growth of my investment, Andy talked about the sovereign wealths coming in, will the growth of my investment outpace inflation? Frankly, the number one for the largest investors in the world today question on a strategic, not a short-term tactical, but a strategic long-term investment. This is an example of Western Europe cities ranked across the major cities from most to least educated. It doesn't mean it says don't invest in Milan, but you take into account in the long-term strategy context the educational level, because it's one of the drivers of better GDP and better growth. Cash flow predictability, reliable cash flow. One of the things people underestimate here is how much of a loss there is to turnover, either capital cost or downtime, leasing cost. And frankly, in the office sector in particular, when I compete to buy assets, it never ceases to amaze me some of the low costs that people will put into the turnover. CBD, US office CBD averages 36% loss from NOI to cash distribution. So your dividend upon which you can then generate your return is literally 2/3 of what the NOI is. Retail, particularly community retail, multifamily, much lower loss factor. Hotels, much higher. By the way, we really don't do hotels very often. Asset outperformance, we talked a little bit about adjacencies to things people want to live next to or they want to see. And we've tracked across different cities. Here's an example in New York where good parks, not bad parks can actually be a detriment to rental rates and to occupancy levels. But good parks that people want to be next to, there's a demonstrable trend for higher rent. Bryant Park, we just built a building that we finished on Bryant Park, the good Penn Bryant Park, and it very much outperformed market by virtue of the fact that people will pay a 40% premium to be adjacent to that park versus a typical location. Chicago, we're building actively in Chicago. Not as good a long-term growth trend in Chicago as New York, but the individual asset selection close to rivers and transportation networks, those assets stay more full. This is a very high level. I'm not going to get into a lot of detail onto how this works, and I've blanked out all of the individual rankings. But the whole point is to compare when we look globally. We think that a global strategy for investing needs to include, and for a given level of expected return, or actually for a given level of unit of risk, you can get a higher expected return by having global. But there's high risks. This compares US and Western Europe to the BRICS. And clearly there's high risks there. And this is one way of trying to quantify those risks. You look at a place like Russia, fraught with corruption. It's very hard to invest there. We have a couple $2 billion invested in Russia. It's a very hard place to conduct business. It's very hard to make sure your people are abiding by not only Russian but US law. At the end of the day, it doesn't mean we eliminate it. We think it's a good place to be. But if your investor has an inability to sustain short-term volatility, it's a very hard place for that investor to be. And you look at India. India on this chart shows great economic growth potential. The currency is hard. The ease of doing business and the transparency is horrible. But we think all of these markets ought to be a part of a long-term investment portfolio if you can sustain the short-term volatility. And you have to understand why they're different. So back to selecting individual markets within any economy. We look at a lot of different things. I've talked about most of them already, but the competitive advantages relative to industry, how many creative industries are there, the educational level. This is a ranking that we've done. It's an illustrative example of some of the top global individual cities as we look at them. Some of I don't think many of those would be surprising to you, but if you spent time on it, it might be surprising which ones are missing. Back to asset selection, just real quickly. This is the hardest to quantify exactly what these premiums are. We did it with the parks example. Here's just 4 buildings that we were involved in over a 25-year period. And it does show that whether or not the actual rent has stayed at the highest level, these assets have stayed at 95% leased, even when markets have dropped to 20% vacant all around them. So the selection drives performance. This I'm going to talk about very quickly, but we have our in-house research group, and we've done a lot of work trying to figure out most econometric models that are in real estate investing are based upon future projection of GDP growth. And the one commonality that exists is that those future projections of GDP growth suck. They just are no good at all. And it drives the models. So we wanted to look at what are some known factors existing at any point in time that have the best predictive ability for future performance. And really, at the end of the day, what it comes down to most, in our view, is relative pricing. It's relative also not only to the trend within that one city, are you above or below, but also with respect to cap rates, the spread of cap rates to alternate investment types, best measured by the local cap rates by product type versus the BBB bond rate in that currency. But you'll look here and you'll see here's San Francisco as an office as an example. If you're a tactical investor and you're trying to invest for the short term, say a 5-year investment period, where you buy is, in terms of how you're going to do, number one is buying the right asset, but two, on the timing, you want to buy when you're below the trend line, not above. In San Francisco today, we're 1.5 almost standard deviations above the trend line on the office value relative pricing index. The relative pricing of a cap rate compression, even though cap rates are so low, is not quite as broad. But it's not a good tactical investment time. However, if you wanted to invest for a very long term, San Francisco has a very steep curve. And in the context of urbanization and long-term trends, that growth curve is more important than what you buy in at by virtue of the fact you look here. This is San Francisco versus office versus the blue line is average office across the United States. Going back 25 years, and then our projection forward 15 years. And again, these are the slopes. These are not the performance. The performances are volatile around these. And frankly, San Francisco with a steep slope happens to be one of the most volatile. But the total growth, if you're a strategic investor, will double what is the average investment in the United States. And that, as a urbanization context, is what you would look at, in my view. And then to finish this off, we talk about the curve and what the actual performance is versus the trend line. The purpose of this, ignore the green shade for a minute. I realize now you're all looking at it, but ignore that for a minute. The blue line and the red line show inverting what I talked about before with the trend line, the actual performance of pricing versus the trend. This shows that if you buy well or if you buy badly, the impact on the total return that occurs over the length of your hold. And what it shows you, it's very simple math, but what it shows you is if you buy very well, so above the line means at a 20% discount, below is at a 20% premium to the long-term stabilized rate. If you buy at a good time or you buy very well, you're going to make a whole lot of money, a very high total return if your hold is a 5-year period or lower. Or you're going to lose a lot of money if it's not a well-executed timing. But on the long term, over the 30-year, the convergence to that stabilized yield. And the convergence to that stabilized yield is not just to the cap rate, it's to the cap rate less that turnover loss we talked about, plus the growth rate. This is the unleveraged return. And that'll get you back to that number. Basically, this is an average using a 6 with the average turnover loss in the US office of about a third, get you down to a 4, and then it comes back up to a 6. But no matter where you buy, if you buy it over a 30-plus year, it converges toward that number. Did I explain that clearly enough? Pretty simple concept, but it drives the notion of strategic investing, in my view. And then to compare the issue, you look at this, and some investors will say to me, why in God's name would I buy a 4 in San Francisco if I can buy a 7 in Phoenix? And what I would say back is, if you're trying to buy a tactical investing, Phoenix is actually at a good point, even on the office sector, in its pricing cycle. Buy that in Phoenix. But if you're trying to buy for a long-term hold... Is that an illustration or based on some actual numbers? Yes. So back to the point. This is an illustration, and this is based on what is pretty close to typical if you include all commercial types across the U.S. In terms of that 6. The actual math is actual, but it's based on a hypothetical of the typical loss to illustrate that it's really driven for the purpose of illustrating the timing. And the green shade that I told you to ignore, we're not going to get into the full of that, but we have one developed to core strategy that we use, and we have statistics that show over our time period that we think you can play to the top half of that curve and ignore the bottom half by virtue of building the best of the Salesforce Tower, state-of-the-art path of growth project. And with our history where it's a function of whether you're going to make a short-term benefit or not, it's not a loss. So that's what that's showing. But this is a hypothetical. But back to the, would you rather buy a 7 in Phoenix or a 4 in San Francisco? Today, I would say a 7 in Phoenix if you're tactical, but for strategy, you'd actually rather buy the 4 in San Francisco. And the reason you'd rather buy a 4 in San Francisco is that a 4 in San Francisco on a long term is actually closer to an 8 under this math. And the 7 in Phoenix is actually, well, let's not call it Phoenix. Anyone here from Phoenix? All right, let's call it Phoenix. At the end of the day, you would not, the 7 in Phoenix is actually closer to a 4. And as you show the math here, in high growth markets, we're starting at a 4. The correlation between, in the high growth markets, the turnover loss and the growth is high. So it's got a lower turnover loss. The 4 becomes a 3.2. The 4.8 growth, believe it or not, brings it up to a high 7s. And then you look at the unnamed below average market, and it starts at a 7 potentially. It loses 50% of its NOI on an average basis over a long-term hold on the turnover loss. That drops it to a 3.5. You add a growth, which is below the U.S. average, is about half the U.S. average, of only 1%, and it brings it to a 4.5. So yes, you'd rather buy a 4 in San Francisco because it's actually an 8 and the 7's actually a 4. This again is then tied, I've sort of shaded out the convergence lines, but it's showing again that then when you buy for the long-term hold, it becomes much less important. So I hope that was of some value. That's what I prepared to talk about. So thank you.
Thanks, Colin.